Good day to all. My name is Chloe, a Senior Research Analyst from iFAST. June was a fantastic month for equity markets. Positive sentiment soared after the Fed hit the brakes on interest rate hikes and inflation data revealed a drop in the core personal consumption expenditure index to 3.8% year-over-year in May. Equities trounced bonds, with the FSM indices all equity delivering impressive return of 5.10% in SGD terms compared to 0.55% for FSM indices all bond. Looking at the performance of the FSM indices, FSM indices Asia x Japan equity was the best performer for the month, delivering returns of 5.5%. Chinese stocks have gone up on the back on higher expectations of fresh stimulus by the Chinese government. Moreover, Asian chipmaker stocks are also riding on the increase in demand for memory chips with the booming AI sector, with the likes of Taiwan's TSMC and South Korea's SK-hynix delivering returns of 5.02% and 4.44% respectively in the month of June. FSM indices Asia Property Equity was the worst performer, however, for the month, with a negative 2.2% decline. Cautious sentiments from the investors still pervade the sector on the back of anticipated rate hikes for the rest of the year, and with interest rates staying higher for longer. REITs in particular are facing headwinds. REITs may be forced to refinance their expiring loans at higher rates, resulting in a higher average cost of debt, impacting their performance. Looking at commodity funds, we note that all energy-related funds delivered positive returns in June. However, we note that the funds invested in gold did not perform well for the month of June, in anticipation of more rate hikes by the Fed going forward, and with Treasury yields also inching upwards, this makes zero-yield bullion look less attractive. Here are some of the final thoughts that we have. So despite equity markets rising strongly in the past few months, the global economy is still not out of the woods, and China's factory activity continues to show signs of slowing down, with the Caixin PMI having eased to 50.5 in June from 50.9 in May, and just remaining above expansionary territory. Similarly, US manufacturing activity contracted in June for the 8th straight month, with the Manufacturing Purchasing Managers Index or the PMI index having dropped to 46 in June from 46.9 in May. Moreover, the decision by the Fed to hold off on a hike in June's meeting came with a projection of another 2/4 percentage points moves on the way before the end of the year. And in this current environment of higher for longer inflation and interest rates, we continue to have a preference for fixed income over equities, particularly investment grade and short duration bonds, in light of rising recession risks. We continue to like markets such as Japan or even ASEAN for its earnings resilience as well as its attractive valuations. To get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗍𝗰 will share more about OUE Limited. Over to you, 𝗍𝗰.
Hi, I'm 𝗍𝗰, Research Analyst at Global Fixed Income. OUE Limited, a prominent brand in Singapore, has witnessed a significant improvement in its business since the initial impact of COVID-19 in 2020. With the tourism industry set to rebound even further in 2023, OUE is in a prime position to experience continued growth. The company has already seen a recovery in its revenue in the fiscal years 2021 and 2022, and this positive trend is expected to carry forward into 2023. OUE is likely a quite known brand in Singapore, particularly with assets like OUE Downtown and OUE Bayfront, while they also manage the Hilton Singapore Orchard, the flagship Hilton brand across Asia Pacific. OUE had been moving past just real estate, which it endeavours into a variety of sectors: commercial, hospitality, retail, residential and healthcare. At the same time, OUE is also the manager for two REITs in Singapore, OUE Commercial REIT and First REIT. For FY 2022, the real estate segment continues to be the main driver of the business, bringing in 68% of the group's turnover collectively under investment properties, hospitality and real estate development. In FY 2022, we saw a substantial rise in the profit after tax at SGD-347 million as compared to the SGD-101 million in FY 2021, which had been a reasonable recovery after losses amounting to SGD-405 million in FY 2020 due to COVID-19. Overall, we are particularly optimistic in two segments of its operations, hospitality and also healthcare. The turnover coming from hospitality is likely going to rise further with the recovery in tourism, especially with the full reopening of Hilton Orchard Singapore this year. For its healthcare segment, we like the diversification into its healthcare business, which should provide for additional stability in income for OUE. Coming to its credit profile, it remains generally decent with some limitations in utilizing their cash. As their cash position is unable to fully cover for their short-term borrowings, it is likely for OUE to rely on further borrowings for them to refinance their ongoing debts. On the bright side, we believe that OUE is unlikely going to face problems with getting additional loans, especially with further room available through secured borrowings. Overall, its credit profile is likely to stay decent in the short term, especially with hospitality expected to continue outperforming in these recent years to provide the much needed cash flow. In terms of investment options, the OUE SP 3.5% maturing in 2026 stands out due to its higher yield to maturity and remaining maturity period of 3.19 years left. With a manageable issuance size of SGD 200 million, OUE is unlikely to encounter refinancing difficulties. Furthermore, the maturity date in 2026 allows ample time for policy rates to stabilize, especially with the recent indications of the US Federal Reserve pausing rate hikes. This creates an opportunity for OUE to refinance at a lower cost, taking advantage of its improving credit profile and a more favorable interest rate environment. In this post-COVID era, OUE has a promising future with room for further improvement, especially in an environment of recovering tourism. The company's outlook for the upcoming years is optimistic. However, it is crucial for OUE to manage its capital carefully in the current high interest rates environment. For investors seeking short to medium-term options, the OUE SP 3.5% provides an optimal choice. That wraps up for the sharing of this week, and do scan the QR code for the full article. Catch us again next week for more investment ideas and updates.